Hello and welcome to this month's market update for September 2025. My name is Steve Latham and I am the Chief Investment Officer for Bernanke Wealth Management. And this month we're going to be talking about the employment picture. This is something that the Federal Reserve has been focusing on quite keenly over the past couple months, as the number of jobs added throughout that period of time has fallen off significantly from the trend over the last couple years. With the Federal Reserve's dual mandate of full employment and stable prices, this is starting to cause them to review the way that they're conducting their interest rate policy, so much so that they may start cutting interest rates as soon as their next meeting in the middle of September. So let's look at a couple pieces of key data that they'll be looking at to show how they could justify lowering interest rates. Now, the first chart you have here in front of you is soft data versus hard data. We've talked about this in previous monthly market updates, where soft data is the data that comes from surveys, so sent out to employees, sent out to businesses about what's going on with their business. It's not necessarily as quantifiable as hard data, which is where you're looking at industry statistics, you're looking at inflation data, you're looking at the hard numbers, how many jobs were actually created. And so when you look at the divergence of the two, you can see how the feeling of the economy might be different than the actual what's happening on boots on the ground economy. And this is exactly what we're seeing here with the employment surveys. So the blue line that you see in front of you, and this goes all the way back to the 80s, so we can see that there's a very clear trend between these two data points. The blue line being U.S. employment expectations, which is aggregated through surveys, so soft data. And the darker line is the change in non-farm payrolls. So basically how many jobs have been added month over month. And you can see over time, over the past 30, 40 years, these have been pretty synchronized, where the expectations for what's happening to the economy closely resembles what's actually happening from an employment standpoint. Now, the interesting thing here is we can see that the expectations, the light blue line, is quite dour. The amount of jobs expected are really close to a low we haven't seen since the great financial crisis. However, that's contradicted by the amount of jobs that are actually being added, which is still positive. Now, one could assume and extrapolate that the amount of jobs added will continue to trend lower just because these two pieces of data have historically been correlated. And that's one of the things that the Federal Reserve is really focusing on here, is if the sourness of the expectations for jobs, it continues to persist, perhaps that could lead into actual jobs not being created. Now, the next chart here, which commiserates with some of this data, is the total U.S. continuing claims, which is basically how many people are continuing to claim unemployment insurance in the United States. Those that are currently seeking a job but cannot find one are eligible for unemployment insurance. And this only goes back to the beginning of 2024, but we can see that there has been a steady increase in total continuing claims since that period of time, where we've gone from 1.75 million people continuing to seek unemployment insurance to just shy of 2 million during that period of time. Now, the absolute number of people seeking unemployment insurance hasn't changed dramatically during that period, but of course we want to look for trends in employment, and that's again exactly what the Federal Reserve is going to be looking at here. The continuing trend higher in unemployment claims is certainly a worrisome one if you're seeking to maintain employment stability. Now, one piece of silver lining here that we can look at is, well, how is the economy reacting? How is the market reacting to this? Of course, if jobs creation is slowing down and unemployment is increasing, that could certainly look like a negative picture for the economy. And one of the pieces of data that we like to look at as far as how market prognosticators or investors are looking at the market is how much premium is being demanded for investing in corporate bonds versus government bonds. And what we can see here is the spread, so the difference in yield that you would get by buying a corporate bond, which carries credit risk, meaning that the company can go bankrupt, versus the government, where theoretically a government cannot go bankrupt. If that spread is really tight, meaning that the premium that you're demanding for that corporate bond is low, that means you take some level of comfort in knowing that there's not a huge economic risk that could cause companies to become more risky to own. And right now, we can see that the spread on investment grade bonds and high yield or junk bonds is close to all-time lows. And what that tells you is the market is not necessarily worried, at least at the time, for how the economy is moving forward, or at least the expectation of how the economy is moving forward as it relates to the jobs market. Now, that doesn't mean that cracks couldn't form in the future, but right now the bond market is telling us, or at least the corporate bond market is telling us, that there's not a lot of worry there, because if there was worry, we would see those spreads really increase and spike. We saw that during COVID right here, and we certainly saw that during the great financial crisis back in 2008 and 2009. So for the time being, when we're looking at the economy, yes, there are some things that are worrisome. That's exactly what the Federal Reserve is going to be looking for right now. And they should be looking at that over the next couple meetings to see what the trend is going forward for unemployment. Because if that starts to break down, that considers more justification for interest rate cuts. And right now, the market is expecting 3 cuts of 0.25% or 25 basis points by the end of the year. So we could see a 0.75% reduction in the overnight rate that the Federal Reserve controls by the end of the year if the market predictions carry forward. That's all for this month. If you have any questions related to the employment picture, the economy, inflation, or anything else, please don't hesitate to reach out. We're always happy to answer your questions. Thank you.